Hello, this is a short presentation to accompany a trading update and the details of an acquisition announced by Zoo Digital Group in April. I'm Stuart Green, I'm the CEO. I'm a co-founder of the business and I'm a large shareholder, having invested capital of my own in the business over the course of the last 15 years. I'd like to begin with a short overview of Zoo for the benefit of those who are new to the story. We're a tech-enabled provider of services to global entertainment. We work for major streaming companies, and what we do for them is provide services to take their finished content, so that's TV series and feature films, and do what's necessary to ensure that that content can go onto streaming platforms and can be enjoyed by audiences globally. That entails media localization services to adapt the content into different languages using subtitle and dubbing. And it also involves some technical services, which we refer to as media services, that ensure that the content will play properly and smoothly, properly synchronized and so on when it goes onto a streaming service. We're differentiated through proprietary software that we've created that enables us to operate in a very efficient and scalable way. We've just announced our pre-close trading statement for the year FY23, that's through to the end of March, in which we've indicated revenues will be at least $90 million, so that's up 28% year on year. Or if you strip out one acquisition that we did about a year ago of a business in India, that represents an organic growth of 25%. It's a little behind the market consensus from analysts, and that's due predominantly to some temporary softening of sales that we've seen from a major customer, which has been going through a reorganization. That affected sales in our February and March period, and we believe that that reorganization will be completed shortly, at which point we understand that we can expect order flow to resume as normal. That growth rate of 28% is a good way above the long-term growth rate and for our plan that we indicated in a capital markets day last year, where we indicated how we expect to get to sales of $400 million over the long term. We've indicated that EBITDA will be at least $12 million, and that's clearly an improvement, a significant improvement on last year, and also in line with market expectations despite that slight softening of sales. And that's due to a better mix of services and also improved margins across each of the major service lines. In the period, we've doubled our cash, so up to almost $12 million. And that compares with market guidance of between $6 and $8 million at year end. So a very good cash outcome and strong balance sheet. That includes having spent around $4 million on CapEx during the course of FY23. On three operational points. Firstly, we indicated recently that we have signed a second major studio that has adopted our Zoo Studio platform. So that's a very specialized ERP system that we provide to our customers to enable them to manage very efficiently their internal operations in assigning work to vendors like us for media localization and media services. That integration is going well, so we'll shortly be completing the implementation of Zoo Studio for that customer, and our expectation is that they will then move into a production phase over the course of the next couple of months. We recently also announced that we bought the rest of Zoo Korea. So that's a company that we've been working with for a number of years, and about a year ago we entered a JV with them and invested to buy 51% of the business, and we very recently acquired the remaining shares in that operation. It has been very successful, as you'll probably appreciate. Increasingly, Korea is a strategically important market for entertainment. Just very recently, Netflix announced their intention to invest about $2.5 billion on content in Korea, which is about double their previous spend. So a very important market for producing very high quality content that is increasingly sought after in global markets. The third bullet here relates to our business in India, which we acquired about a year ago. This is our third production hub now after the US and the UK. It has performed ahead of expectations, and it provides us with a lower cost location for delivery of media services, as well, of course, a location for us to perform localization services in multiple languages for the Indian subcontinent. We're working currently to actually establish a second operation in India. That will be in Chennai, which is in the south of the country, particularly focused on providing language services in the languages spoken in the southern part of the country. It's worth just taking a moment to reflect on how our growth strategy has played out over the course of the last 4 years. During that period, we've delivered strong organic growth, revenue CAGR of about 32%, and for EBITDA over 55%. So the organic growth strategy that we have has been supported by strategic investments of the kind that I've just touched on in India and Korea. And so we have been in the process of establishing a global network by investing in some key strategic assets. And what we find is that when we add new locations, that results in customers giving us more global business. And that's illustrated by some information that we provided recently in Korea, where the very fact of having a Korea operation as part of Zoo Digital Group attracted an incremental $4.5 million of business. That's both direct and indirect business from customers who are now using us to produce their localized assets for the wider Southeast Asian region. In our plan for establishing these global operations, all of the locations we have are working within Zoo's platforms. And those platforms not only deliver efficiencies, operational efficiencies that make us able to perform services at scale, but they also embed a whole range of security features to ensure that assets belonging to our customers are always safeguarded. The platforms also centralize data. So what that means is that when we begin a project for a customer, we keep a single copy of the assets associated with that project within our systems. And each of the territory operations will be working from that same information. So what that does, of course, is ensure that everybody's always working from the same data. So if our customer updates some information, we can be certain that all our territory operations will receive that update simultaneously. The systems also ensure a huge degree of consistency, not only in the output of our services and the high quality that we deliver, but also the processes and workflows that we follow in order to do this work. The systems finally give us visibility of what's happening. So within the systems, we can see at any time, in real time, what projects are in progress at each location, how those projects are progressing. And indeed, that is a feature that our customers see great benefit in as well. So this combination of features and capabilities that come from our platforms ensures that when we make these investments of the kind I've described, we have fantastic visibility and control over the way in which those operations function. And that gives us, a great deal of confidence that the services that we will provide across those different operations will be to the same consistent high quality. There are now more US global media platforms that are going to be rolling out internationally. There are 3 key services that have launched in North America and that have recently announced their intentions to go international. One of which we have already signed as a customer, and I mentioned that on the previous slide. 2 others we are in dialogue with, and we believe that we're very well placed to be able to serve their needs too as they push forward with their international rollout. So going forward, we'll continue to focus on organic growth, and the acquisitions that we'll continue to explore are intended to provide us with expertise, reputation, and capacity for the specific territories, especially in the area of dubbing. And in each case, we will deploy our platforms, and that will enable us to deliver those services at scale for the benefit of our customers. To that end, we're currently in discussions with 5 potential targets across different locations. And I'd now like to turn to talking through the details of one of those acquisitions, which we've recently announced. So we've just announced our intention to acquire a business in Japan. So this is an opportunity that's arisen very recently, and there's a short timeline through to completion. We submitted an indicative offer to acquire 100% of the share capital of this business in March, and we were informed in April that we were the preferred bidder, and we're now moving forward to provide a binding offer once we've completed our due diligence, and that's expected to be provided in May. We then expect, and the vendor has indicated their desire to complete this in calendar Q3. Given the regulatory requirements in Japan, we think in practice that's likely to be August or September. The business is a media localization subsidiary of a large Japanese parent, and it's actually a trusted partner of Zoo. It's a company that we've worked with for many years, and indeed they are already using some of our platforms. Unfortunately, at this stage, I can't share too much about the financials of the business or indeed the identity of the business because we're not yet at the binding offer stage, but I can tell you that the business is profitable and also that it is in revenue terms, it's larger than any of the investments we've made over the course of the last year or two. What I can also tell you is that the acquisition will be accretive in its first full year, and we expect it to provide enhancement to EPS of at least 10%. This company, as I mentioned, is already a partner. It's actually one of 3 partners that we have in Japan. It employs about 50 people. And as I mentioned, it's already using our platforms. So in effect, we've had a try before you buy with this asset in the same way that we have with the previous investments that we've made. That obviously is very beneficial from our perspective in terms of de-risking these acquisitions. Due diligence is in progress, so we have access to a data room, and we expect that to be completed over the coming weeks. We've taken some soundings from customers as part of our own commercial due diligence, and all feedback we've received indicates that this target is viewed favourably by our customers who are already buying services for Japanese language in the country, and therefore we have a very strong indication that work will follow in Japanese as a consequence of our acquisition of this target. I'll just say a few words about the entertainment market in Japan. It's obviously an important market. In fact, Korea and Japan are the 2 key countries in Southeast Asia at the moment for entertainment, the 2 largest and longest established entertainment centers. As I mentioned, those forthcoming launches of US streaming services will inevitably be targeting Japan as one of the key markets in Southeast Asia. Due to some cultural factors, Japanese language business for us has been fulfilled to date through partners. There are certain reasons why Zoo's ideal model we've not been able to operate that effectively in Japan to date, and that's because we don't have a base there. So having a base through this acquisition provides us with the opportunity to implement our approaches to the work that we do and to deliver improved margins for Japanese work. So in addition to taking Western content and localizing it for the Japanese market, there's also a significant export market from Japan, particularly for anime content. So this is increasingly sought after in many countries around the world. So there is a requirement in the market to take Japanese original programs and to adapt that content authentically for audiences in different countries speaking different languages. So again, having access to this asset will put us in an excellent place to be able to capitalize on that market opportunity. Within the country of Japan, historically, where audiences have viewed non-Japanese original content, the tendency has been to do so with subtitles. What has happened in recent years is there has been a shift towards dubbing as a preferred method of consuming non-Japanese content, and therefore we see the demand for dubbing into Japanese growing quite strongly. Across the entertainment industry in Japan more widely, revenues are forecast to grow by nearly 8% CAGR through to 2027. So despite the fact that this is a long established market, it's still fast growing. So in summary then, we delivered strong organic growth in our FY23, and we provide indication of that now, and of course more details of that will come in our preliminary results in July. The growth rate that we've delivered in that period puts us on track with our long-term plan that we outlined at Capital Markets Day last October. We found a really exciting opportunity to establish operations in Japan, and of course Japan, along with Korea, is one of the two most important markets in Southeast Asia. This will be an acquisition, 100% acquisition of a business, and will be accretive to at least 10% in its first full year. We're confident that we can replicate in Japan what we've achieved in both India and Korea through the investments that we've made there. And with this asset, we expect to be able to win business from major US streaming services as they push ahead with their international rollouts, and in particular their plans for Southeast Asia. So we see this as an important stepping stone in Zoo's global proposition, and Japan is a very important market for our customers, and therefore it must also be a very important market for us too. So consequently, the board remains confident in delivering long-term growth for the Zoo business. Thank you for listening.